When markets speak, the most successful investors listen. But how can you do the same? How can you figure out which market moves to listen to, which to ignore, and most importantly, take advantage of the signals the important ones are sending out? Joining me to share his insights is another all-new guest on the Money Show MoneyMasters Podcast. He has a long and distinguished history of identifying big macro trends and warning of some of the biggest market pitfalls of the last couple of decades. He is Larry McDonald, founder of the Bear Traps Report and author of the 2024 book, How to Listen When Markets Speak. Larry, welcome to the podcast. Well, Larry, I do appreciate you taking some time out to chat, especially since you're on the proverbial road here. I haven't had you on the podcast before, so I was wondering briefly if you could just talk a little bit about your background and the Bear Traps Report. I mean, as a trader, I know what a bear trap is, but I'm curious why you went with that name for your publication and your research platform.
Thank you, Mike, and thanks so much to the Money Show. What a platform you guys have built over the last decade. Thank you very much for that. So our first book was published in 12 languages. It's a New York Times bestseller. And I quickly learned, it's a little inside baseball joke, but you make about 10 times more on the speaking tour than you do writing the book. And so we did about 140 speeches, 16 countries around the world, working with, the big Fidelities, the Janices, all the big funds. Yep. And then, what we did was we developed kind of a Bloomberg chat with the people that we met. And so we met some incredibly talented people, and I'm so grateful to our contributors. So what we host at the Bear Traps Report every day globally is kind of like a live ideas dinner.
Yeah.
Where, you have a conversation with the best hedge fund managers in the world. Most of it's anonymous, but because we've been to London maybe 8 times in the last decade, Toronto, Montreal, LA, we've just built some incredible relationships. And that's how we produced our second book, How to Listen When Markets Speak. This book is, we sit down with David Tepper, we sit down with Charlie Munger, we sit down with David Einhorn, and some of the greats, Neil Ferguson. And it was all about those deposits and those relationships that we built over 15 years coming off the first book. And that is what we want to bring to the Money Show audience in July.
Well, I'm thrilled. We're extremely pleased to have you there in Vegas. And I do want to talk about the book a little bit. I mean, obviously, you have a goal there with this new book. You want to teach investors something. What are some of those goals? What are investors going to get out of this book from you?
Well, it's there's no I in team. So it's about kind of learning, and it's about paying attention. And so what I think people need to do in watching our event this summer is really kind of build mentors. You want to, build great mentors and develop relationships with people around the world that you can trust and gain trust. It's all about asking and making deposits, and then getting the withdrawals by working with some great mentors. And that's what we've done. But in terms of investment ideas, the one thing that we're getting from the chat, and so once again, we host a live conversation on the Bloomberg terminal, on the Discord, with hedge funds, mutual funds, and pension funds in more than 20 countries.
Yep.
The one thing, Mike, that I'm hearing this last 8 weeks is that for the first time, you've got, your stocks have been down, your bonds have been down, and your dollar's down. And those global allocators are really looking at the United States in a different way. And what's fascinating is we've had multiple big clients come in and ask us about treasury issuance, about what's called the TGA, the Treasury General Account, how much money's in there. We've got right around the time of our event in July, we've got a real kind of showdown on the debt ceiling. This is going to be incredible for July and August. And so what institutional investors want to know is the United States is becoming just a tiny, tiny, tiny little bit more like an emerging market country in the sense that we have a lot of debt issuance to catch up on. Yeah. In other words, right now you're at the debt ceiling, so there's no new debt issuance. But after our conference in July, from late July to the end of the year, Mike, they have to catch up. And this is going to be pretty incredible. That's why you're starting to see things like the SLR being floated by Scott Bessent, and it has some huge impact on equity investors. Because, so from the bottom line, from what I can hear, clients have an interest in kind of a new product where we're looking at treasury issuance, we're looking at the budget, we're looking at tax receipts, we're looking at the TGA, the RRP. And the bottom line is people want to figure out, how much debt is coming to the market for sale in the second half of the year, and how are we going to raise that money? Is it going to be from institutional investors? Is it going to be from the banks through the SLR? This is what we have to get down, because it's going to have a huge impact on equities.
Well, interest rates have to be the real story here, right? I mean, you've got things like the announcement out of Japan. They're going to kind of tweak how they're issuing debt to maybe help at the long end of the curve there. Obviously, you mentioned some of the things that could happen with banking regulation and so on here in the U.S. How do you see that unfolding as the year goes on?
Well, one of the points we make in the book, How to Listen When Markets Speak, is around financial repression. And so the only way you get out of a $37, $38 trillion debt hole, there's two ways. There's default, or there's keeping interest rates or massaging interest rates below the rate of inflation. And so one of the points we make in the book is around things like this SLR move, where they're going to try to force different types of investors to own more treasuries. They may force our trading partners to own more treasuries, and they want to get rates below the rate of inflation. And what that means is that 2010 to 2020 portfolio doesn't work anymore, because that was a disinflationary regime portfolio. Now we're looking for a regime shift where we're looking toward financial repression. And in a financial repression world, you need a portfolio that has a whole different construction.
And let's talk about that a little bit. I mean, obviously, so far this year, despite the original kind of Trump trade, which was buy America, so far this year, it's essentially at times been sell America, U.S. bonds, U.S. dollar, U.S. stocks relative to foreign stocks. How do you see that all unfolding?
Well, that's it. It's the 2010 to 2020 portfolio was U.S. centric, growth stocks, real crowded trade. And the bigger it got, the more passive funds own the same things. Now, this 2025 to 35 portfolio, much more international stocks, much more value, much more emerging markets. We love Brazil, but it's also companies that own hard assets, companies that own things where if you're in an elevated bond yield regime with higher sustained inflation, you want to be in a portfolio of companies that own hard assets.
Got it. And I mean, I would assume that would include things that when people think of hard assets, they think of gold, they think of mining companies, things like that. Is that what you're looking at, or what else are you kind of putting in that bucket?
Yeah, so your Rio Tintos, your PHPs, your Exxons, your natural gas companies, that's not a hard asset, but natural gas is a huge AI winner. And just look at the NUKZ ETF. We've been recommending that in trade alerts over the last 2 months. And it's a portfolio of what we call independent power producers and companies in the nuclear uranium space. And so that type of portfolio is outperforming the semiconductors, which is the street's consensus AI trade, by over 50% over the last 6-9 months. That's the type of portfolio construction that's going to work the next 10 years.
Got it. Earlier in an interview you had, I think it was on Fox Business with Maria Bartiromo, you talked about sort of one of the scarier scenarios was the 4,000, S&P 4,000, gold 4,000. Do you think something like that is likely possible? How worried should general stock investors be about this environment we have?
Well, the indexes are, if you just look at NVIDIA, it's $3.3 trillion. And the top 3 stocks in the NUKZ are less than $300 billion. So NVIDIA, one stock that's in the S&P, is so large compared to all the other players in AI. And so the point that we're kind of making is that the index construction of the S&P 500 through passive has gotten so distorted that, you could see through a softening of the economy, through elevated inflation, you could see a move. Like you probably are right now in a 1968 to 1981 regime where the stock market doesn't go anywhere, but within the market, there are sectors that really shine.
Got it. Got it. And in some of those international markets, obviously, you mentioned Brazil was one. Are there others particularly that look promising to you, either regions or single countries?
Well, Indonesia has been really hammered. There's been some political stress there. That's really speculative. Um, Peru and Chile, you got very large copper exposure there. They should be just wonderful places to be in the next 10 years. We are facing a copper shortage of unprecedented proportions. Just look at the Ukraine rebuild. Look at the U.S. power grid. The next to $2 trillion rebuild for the U.S. power grid to support AI. $2 trillion bucks. A lot of copper there. Robotics. We're going to need 2 million robots. If you do the math, that's a lot of copper. And so the LA rebuild, right? Los Angeles, it's going to be slow, but it has to be rebuilt. So Ukraine, LA, robotics, the US power grid, we are coming into a spectacular bull market for copper, and countries that are big copper producers, your Chiles and your Perus, those types of ETFs really will do quite well.
Got it. What about your thoughts on Bitcoin? You had a post recently on X talking about how it seemed to be maturing. That part of the market was maturing, and I'm kind of interested in whether we're finally breaking that Bitcoin is just tech on steroids. It's more like a digital gold type asset. I was wondering about your thoughts there.
Yeah, what's annoyed me about Bitcoin, and we're big Bitcoin supporters in the book, but what annoys me is that, like in August, for example, you had the Bank of Japan, some stress there, carry traders blowing up, and in 3 days, because of liquidity, Bitcoin's off 35% in literally 3 or 4 days. That's not a store of value. That's an asset that hurts families, that hurts young kids, that puke it out. You know, those 3 drawdowns of 80, 90% since 2017 have hurt a lot of people. But what's encouraging is because we've gone into this new regime of bonds down, stocks down, dollar down, a number of days in the last 30 days. We probably had like 12 days in the last 45, 50 days where stocks are down, bonds are down, and the dollar's down. And it's interesting, and I'm really happy for Bitcoin people that own it, because it's interesting that on those types of days, Bitcoin's doing just fine, and which is the total regime shift. Yeah, so I think something's going on there with Bitcoin.
Okay. Good. Perfect. Thoughts on the economy? That's one thing we kind of didn't really cover. I mean, do you think recession worries are overblown, understated? What are your thoughts there?
Well, right now, you know, the one trade that's worked over the last 2-3 years is that we've had periods where you go from hard landing expectations are high, like think of fourth quarter 2023, right? Or 22, 23. I should say the first, second quarter of 23 with the banks blowing up. In late 22. So you've gone through periods where that hard landing expectation is high, and that was, go back to April 7th of this year. The perception of a hard landing was very high. Now we're back to the perception of a soft landing is high. And so the key to the last 4 years is fading that. Like, in other words, when you see that soft landing projection from the street coming out, you want to be lightening stocks, raising cash. And then when those expectations of a hard landing rise, that's when you want to be putting more money to work. But yeah, bottom line is, are we going to have some type of recession here in the next like 6-9 months? We're seeing, yes, we're seeing big moves into big trend shifts in volatility in what we call buy now, pay later names. So your subprime lenders, your alley financials, you know, your credit acceptance companies, your Affirm, UPST, you've got Upstart, you've got a lot of these subprime lenders that are showing real weakness relative to the big financials. And to me, that's something that it reminds me of late fourth quarter 2007.
Got it. Okay. You know, the time we have left, I guess one macro topic we haven't covered is really central banks and particularly the Fed, sort of what your thoughts are there. I mean, you know, they've been sitting on their hands for a while after those cuts last year. What are your thoughts on the outlook?
Well, we're going to have a new Fed governor this time next year. You know, Powell, his term is over, and Trump's going to appoint probably a more market-friendly Fed governor. And then at the end of the day, the Fed's playing tough guy. They're creating some stresses on like I said, on the subprime side. Yeah, so does the Fed cut rates a lot more than expectations from here for the next 6-9 months? Yes. Like, in other words, the probability that the Fed can stay this hawkish. I mean, higher for longer creates a lot of problems in commercial real estate. It creates a lot of problems for the bottom 60% of consumers, home buyers. I mean, home affordability is a complete joke. It's a disaster right now for home affordability. So is the Fed politically pushed into more cuts? Yeah, we're going to have a lot more dovish Fed the next 6-9 months than we have right now.
Good. I guess one of my last questions would be any kind of out of consensus ideas, trends, or something we haven't talked about yet, but that intrigue you from at this point in time?
Well, the one thing is that we're seeing some clients on the institutional chat. They're buying platinum, palladium. So if you think of platinum, palladium, the entire market cap is $350 billion, right? It's tiny relative to gold's close to 18 trillion, silver, maybe 1.6 trillion. So platinum and palladium, if you go into that hard asset regime, your Sibanye Stillwaters, your Impala Platinums, these stocks are breaking out. We've been recommending them the last 6 months. It's the unloved kind of what we call the bombed out village, right? It reminds me of Cameco, your uranium names in the late 2020, 21. We're talking about a bombed out village. We're talking about a multiple year bear market where every rally was a fade and you had lower highs and lower lows. And now you're coming out of that. You're coming into the turn for platinum, palladium for a whole bunch of different reasons. You got buyers in China. You've got a big move toward hybrids. And you have a world that needs hard assets now. So yeah, do I want to own platinum and palladium relative to Bitcoin right now? If I had $1 million, so I put it in platinum and palladium or Bitcoin at the highs, platinum and palladium.
Okay. Well, Larry, I really do appreciate you taking some time out to chat here, especially on the road. Viewers, if you're watching this and you want to learn more from Larry, he is going to be joining us for the first time at the Money Show Masters Symposium in Las Vegas. It runs July 15th to 17th at Caesar's Palace this year, an all-new venue for us. You can check out the details in the description below. We'd love to see you there. Larry, congratulations on the book. Thanks for joining me, and look forward to seeing you in July.
Thank you, Mike. And pick one up for the grandkids. Not you. You're too young for grandkids. Thanks.
Oh, yeah, I got one of them, believe it or not.
Okay. Thank you, Mike. Bye-bye.